It sounds like a bad joke. It sounds like the plot of a B-movie political thriller. But check the date. It is January 20th, 2026. And the global economy is staring down the barrel of a loaded gun. For 70 years, the transatlantic alliance, the trade relationship between the United States and Europe, has been the bedrock of the global financial system. It is the reason you have affordable goods in Walmart. It is the reason your 401k has compounded over the last decade. It is the spine of the Western world. But as of this morning, that spine has snapped. President Donald Trump has pulled the trigger on a threat that Wall Street largely dismissed as campaign bluster. Starting February 1st, that is less than 2 weeks from today, a 10% tariff slams down on goods from 8 key European nations. By June, that number rockets to 25%. Why? Because Denmark refused to sell Greenland. Yes, you heard that right. But before you laugh, look at the numbers. The European Union isn't laughing. They are preparing a retaliatory nuclear option, a $108 billion counterstrike targeting American industries. We are talking about Boeing. We are talking about the auto industry. We are talking about Kentucky Bourbon. We are witnessing the beginning of a trade war that makes the 2018 friction with China look like a friendly handshake. And if you are sitting in New York, London, or Toronto thinking, this is just politics, you are dead wrong. This is about to hit your inflation rate, your interest rates, and the value of every single asset you own. Today, we are peeling back the layers of this geopolitical nightmare. We're going to look at the secret weapon Europe is about to unleash, the Besant doctrine that the US Treasury is gambling your money on, and exactly what you need to do before February 1st. Welcome to the breakdown. Let's cut through the noise. How did we get here? On Saturday, President Trump announced that unless a deal is reached for the purchase of Greenland, the United States will impose a 10% levy on imports from 8 specific European countries. This list includes the heavy hitters: Germany, France, the UK, Sweden, the Netherlands, and of course, Denmark. The catalyst? A military exercise. A handful of NATO allies announced token planning exercises in Greenland, a semi-autonomous Danish territory. We're talking about a few dozen troops. In fact, reports from the German newspaper Bild confirmed that a German reconnaissance team was on the ground for exactly 44 hours before heading home. To the White House, this wasn't an exercise. It was an insult. It was viewed as an obstacle to American strategic interests in the Arctic. Now, we have to understand the economics of the Arctic for a second. This isn't just about ice and polar bears. Greenland is potentially sitting on some of the world's largest untouched deposits of rare earth minerals, the stuff that powers your iPhone, your Tesla, and the guidance chips in F-35 fighter jets. As the ice melts, shipping lanes open up. Controlling Greenland is about controlling the logistics of the next century. But in the world of high finance and diplomacy, you don't just demand to buy a sovereign territory. And you certainly don't blackmail your oldest allies to do it. Or, at least, you didn't used to. UK Prime Minister Keir Starmer has called the move completely wrong. French President Emmanuel Macron called it unacceptable. But words are cheap. What's expensive is the retaliation. Wall Street has been pricing in a business-friendly environment for 2026. The European equities market was actually rallying, outperforming the US in Q4 of 2025 because investors saw value in German fiscal spending and lower interest rates. That rally just hit a brick wall. The European Union is not rolling over. Representatives from the EU's 27 nations met on Sunday, and the mood in Brussels isn't fear, it's fury. Here is the bullet that should worry every American exporter: the EU is in talks to activate the Anti-Coercion Instrument, or ACI. Most of you have never heard of this. You need to learn it today. The ACI is a legislative weapon designed by the EU specifically for a moment like this. It was created to stop countries like China from bullying member states like Lithuania. It has never been used. It was designed as a deterrent, a doomsday machine that sits in the corner to ensure everyone plays nice. Macron is pushing to turn the key and launch it. So, what does the ACI actually do? It's not just tariffs. Tariffs are the old way of fighting. The ACI allows the EU to 1. Block American companies from bidding on public contracts in Europe. Think about the billions in cloud computing or defense contracts for US tech and industrial giants. Gone. 2. Impose strict new taxes on digital services. 3. Halt approvals for US products, specifically in biotech and chemicals. And then, there are the traditional tariffs. The EU has already prepared a list covering 93 billion euros, that's about $108 billion of US goods. This isn't a random list. It is politically calculated to inflict maximum pain on the US electorate. They are targeting swing state industries. Boeing aircraft. US-made cars. Bourbon. Consider the timing. The US manufacturing sector is already fragile. If Boeing loses the European market even temporarily to Airbus, that market share doesn't just come back when the tariffs drop. It's gone for a generation. There is another casualty here that the mainstream media is glossing over. Until 48 hours ago, there was a July trade deal on the table. It was controversial, sure. The EU had agreed to remove nearly all tariffs on American products, while accepting a 15% duty on their exports to the US and a massive 50% on steel and aluminum. It was a lopsided deal. It was a deal that favored Washington heavily. And Europe swallowed it to keep the peace. That deal is now dead in the water. The European People's Party, the largest political group in the European Parliament, has stated they will block the ratification. Stefan Löfven, president of the Party of European Socialists, said Trump has triggered an avalanche that threatens to destroy decades of transatlantic cooperation. Why does this matter to your wallet? Because the market hates uncertainty. But the market really hates missed opportunities. US exporters were banking on that zero tariff access to Europe to boost Q1 and Q2 earnings in 2026. Analysts had baked those numbers into stock prices. Now, not only are those tariffs not going to zero, they are facing a potential wall. The 50% tariff on steel and aluminum remains, and the US has expanded the list to hundreds of downstream products containing those metals. This is a supply chain shock waiting to happen. If you are building a house, buying a car, or investing in infrastructure stocks, costs are about to spike. Let's bring this home. Why should a software engineer in San Francisco or a retiree in Florida care about Danish politics? Because of inflation rebound. We spent the last 3 years fighting to get inflation back to 2%. We finally got close. But tariffs are, mathematically, a tax on consumers. If the US government slaps a 25% tariff on German machinery, Swedish cars, and French pharmaceuticals, who pays for that? You do. Importers don't eat that cost, they pass it on to you. Bloomberg Economics estimates that if Trump follows through with the full 25% threat, exports from Germany, Sweden, and Denmark to the US could be cut by 50%. That is a massive supply shock. When supply drops and demand stays steady, prices rise. Here is the nightmare scenario for the US economy in 2026. 1. Tariffs spike prices on imported goods. 2. US domestic producers raise their prices because they have less competition. 3. CPI ticks up to 3.5% or 4%. 4. The Federal Reserve panics. The Fed cannot cut interest rates if inflation is rising. Wall Street has been betting everything on rate cuts this year to keep the housing market afloat and to refinance corporate debt. If Jerome Powell has to hold rates high or, God forbid, raise them because of a trade war-induced inflation spike, the S&P 500 will not just correct. It will bleed out. We are talking about a stagflationary impulse, stagnant growth caused by broken trade, combined with rising prices. Now, you might be thinking, surely the administration knows this? Surely there's a plan? There is a plan. It's called leverage. U.S. Treasury Secretary Scott Bessent went on NBC's Meet the Press on Sunday and essentially dismissed the European threats. His quote is chilling in its confidence. He said, "Europeans project weakness, US projects strength. The European leaders will come around and they will understand that they need to be under the US security umbrella." This is the Bessent doctrine. The belief is that Europe is so dependent on the US military for protection against Russia, and so dependent on the US consumer market for their exports, that they will eventually fold. The administration is betting that Germany and France will sacrifice their economic dignity to keep the US in NATO. It's a high-stakes game of chicken. Bessent is betting that the EU is bluffing. He's betting that the 27 member states will argue amongst themselves and fail to unify. But here is where the calculation might be wrong. European Council President Antonio Costa stated explicitly that the bloc is united. Even Sweden's Ulf Kristersson, usually very pro-American, said his country won't be blackmailed. The sentiment in Europe has shifted. In 2016, they were shocked. In 2026, they are prepared. They have the ACI. They have the retaliation lists ready. If Bessent is wrong, and Europe doesn't fold if they actually choose to decouple from the US trade sphere rather than submit to coercion, we are looking at the fragmentation of the West. We are seeing a scenario where German capital, instead of flowing into US treasuries, starts looking elsewhere. Maybe they double down on trade with India. Maybe they accelerate their energy independence. If foreign demand for the US dollar weakens because trade wars reduce the volume of global trade conducted in dollars, we have a currency problem on top of a stock market problem. I want to take you back to 1930. The US passed the Smoot-Hawley Tariff Act, intended to protect American farmers and workers. It raised tariffs on thousands of imported goods. The result? Other nations retaliated. Global trade plummeted by 66%. It turned a recession into the Great Depression. I'm not saying we are heading for a Great Depression. The global economy is different now. It's more digital, more resilient. But the mechanism is the same. When you choke off trade to force a political outcome, you create inefficiencies that destroy wealth. We are already seeing the cracks. U.S. Senators Tom Tillis and Jeanne Shaheen issued a joint statement begging the administration to turn off the threats and turn on diplomacy. When you have bipartisan panic in the US Senate, you know the situation is volatile. They know that bad for American businesses translates to layoffs in their home states. So, we are 10 days away from the deadline. February 1st. What happens next? Let's game out the 3 scenarios so you can position your portfolio. Scenario 1, the Davos deal. NATO chief Mark Rutte is meeting Trump in Davos later this week. Rutte is a pragmatist, he's trying to smooth this over. The outcome, Trump gets a symbolic win, maybe expanded US access to Greenland bases or a joint resource exploration committee. He delays the tariffs. Market reaction, a massive relief rally. Stocks soar. The dollar stabilizes. If you are sitting in cash, you might miss the bounce. Scenario 2, the trade war light. The tariffs go into effect on February 1st at 10%. The EU retaliates with proportional tariffs, but holds back the nuclear option. The outcome, a slow grind downwards. Inflation ticks up slightly. Volatility increases. Consumer staples and defense stocks outperform, tech and consumer discretionary lag. The market enters a wait-and-see mode for the June 25% hike. Scenario 3, full decoupling. Trump doubles down instantly. The EU triggers the ACI. The trade deal is formally ripped up. The outcome, market correction of 15 to 20%. Supply chain chaos. Manufacturing halts in sectors dependent on European parts. Inflation spikes. This is the black swan event of 2026. So, what is the play? First, look at your exposure to companies with high European revenue. If a company makes 40% of its money in the EU, and the EU is about to ban it from public contracts or slap a 25% tariff on it, that stock is radioactive right now. Second, watch the US dollar index. If this escalates, the dollar usually spikes initially, but if the EU effectively retaliates and reduces trade reliance, we could see long-term weakness. Third, keep an eye on defense stocks. Ironically, geopolitical tension usually boosts the defense sector, but if NATO begins to fracture, the funding models for companies like Lockheed Martin or RTX could get complicated. However, European defense firms might surge as Europe realizes it needs to build its own military-industrial base, independent of the US. President Trump has triggered an avalanche. Whether it can be stopped before it buries the global economy depends on what happens in Davos this week. The US Treasury believes Europe is weak. Europe believes the US is reckless. And when two massive powers miscalculate each other's resolve, the little guy, the investor, the worker, the saver usually gets crushed in the middle. February 1st is the deadline. But the markets will move before then. Don't be asleep at the wheel. I'm watching the wires closely. If the ACI is triggered, I'll have an emergency update out immediately. Until then, stay liquid, stay skeptical, and watch your portfolio.